Hello and welcome to the Killik & Co podcast for Friday, the 5th of February 2016. This week we've seen fairly mixed economic data, further risk aversion and some dovish central bank commentaries which have supported core government bond yields. Yields on UK, US and German 10-year bonds are now down more than 30 basis points each since the start of the year, while Japanese 10-year bonds have fallen to a yield of just 0.02%. This is the lowest on record as uncertainty about the global economic outlook continues to support fixed income markets. And here we can see a chart of Japanese 10-year bond rates back since 1991, the significant fall that's been seen there. Moving on to the UK, the Bank of England turned more dovish this week, voting unanimously to keep interest rates unchanged. The bank also cut its GDP growth and inflation forecasts. So it's cut the 2016 GDP forecast to 2.2% and the 2017 forecast 2.4%. That's a 30 basis point cut on both years. Inflation is now not forecast to be at the 2% targeted level until the first quarter of 2018 and is expected to remain below 1% for the rest of the year. This has reinforced the market's view that interest rates are unlikely to rise before the end of 2016. And here you can see a chart that's done by Morgan Stanley that looks at the number of months that the market is estimating until the next UK interest rate rise. And you can see this big jump up that we've seen this year to date on this measure. In the US, economic data ahead of this afternoon's employment record have been fairly disappointing. So the manufacturing ISM fell short of market expectations at 48.2, while non-manufacturing ISM has fallen from 55.3 to 53.5. Looking at the employment segment, the employment component of the ISM surveys, both manufacturing and non-manufacturing have been weak. The decline in the manufacturing sector to 45.9 is now the lowest since 2009, while the decline in non-manufacturing is the lowest in the past 12 months. And you can see here the manufacturing is back sort of to just after the financial crisis levels. So we're in the middle of the Q4 earnings season in the US now. So 287 companies in the S&P have reported. In general, we are tracking towards a more negative revenue surprises than usual. So you can see here the red line, that the red portion is larger than it's been on average this year. However, looking at earnings, this has not been translated through to missed EPS numbers, where we still are sitting at around 78% positive. This can be driven by things like share buybacks. We've also seen fairly large share price movements in this earnings season, driven by company guidance changes. So just looking at some of the companies that have been in the news this week that we follow. So Alphabet, that's the old Google, reported results this week. They were better than expected. This has basically been driven by an improvement in mobile advertising revenues. This had been an area where Google had been suffering as there was a move towards users using more mobile devices for searching and mobile advertising having generally lower rates. But now you've seen a strong shift in terms of revenue coming from this area, and there was a very strong driver in terms of mobile search for internet shopping over the holiday season. Vodafone also had a trading update, so there they confirmed that the investment they've been doing under their Project Spring initiative has resulted in improved customer experience and greater data usage. And this has arrested the decline in European service revenues to a large extent. And then in the emerging market business, that continues to perform well, especially countries such as South Africa, Turkey and Egypt. Syngenta this week confirmed that it is that the board is recommending an offer that it's received from ChemChina. This all-cash offer values the stock at around 480 Swiss francs, a considerable premium to the current share price. Here you can see it's still trading well below that level. in terms of obstacles to this offer going through, well, the funding is reportedly in place with debt funding from major banks. There is unlikely to be any competition issues given the fact there's no real business overlap between Syngenta and ChemChina's existing business. However, there is potentially an issue around political opposition to the fact that a Chinese state-owned enterprise could be owning one of the world's most important agri-chemical companies. However, we do believe that the bid does have a high likelihood of going through, and we are still buyers of the stock. In terms of the week ahead, just looking at some of the stocks that we cover that are reporting next week. So we've got Walt Disney, Solar City, and Sanofi on Tuesday. Then on Wednesday, Whole Foods Market, Expedia and Baidu reporting in the US. Thursday, Glencore, TripAdvisor and PepsiCo. And then on Thursday, it will be Rolls-Royce Holdings reporting. Just in terms of highlighting a few of the results, so Disney's results will be out next week. We think there are two things that investors will focus on there. First of all, they'll be looking at whether there be any further losses of subscribers in ESPN. That's the US's leading sports cable network. That's an issue that has been affecting investor sentiment towards the stock over the past sort of 6 months. The other thing that will be looked at is what's happening on the studios side and how the strength of the Star Wars movie that's been released recently is driving results there. Longer term, over the rest of the year, people will be looking at the impact of the opening of Disney Shanghai towards the middle of the year. And then Whole Foods will also be reporting results next week. We'd originally gone into that stock as a way of gaining exposure towards consumers' desire to have more sort of organic and natural foods. It has been suffering from increased competition as more organic foods have been introduced by the traditional supermarkets in the US, such as Kroger and Walmart. That has impacted at sales and margins. It is now introducing a new sort of everyday format called 365, where they're going to sell more basic foods at cheaper prices, and so that could be an important turnaround agent for the stock going forward. In terms of this earnings release, we still do believe that the earnings could be quite volatile over this period. Thanks very much. That's all from us this week, and we'll see you again next week.